Neelkanth Mishra, India equity strategist with Credit Suisse, to talk about both macros and what we should expect for 2019. And Neelkanth, welcome back to the show. Is it what I'm noticing? I just noticed, Neelkanth, there is graying on your mustache. Is that pressure? Is that wisdom? What is going on?
It is genes. So I think I've been graying for quite a while now.
You must interact more often, otherwise next time when we'll meet after a long gap, maybe I'll notice something else. But welcome back. Great to have you back on the show.
That's so mean.
Okay. No, I'm just telling him that he should be coming more often on ET now. That was my entire indirect pitch to Neelkanth.
We still recognize him. Don't worry.
Okay. Now that we've had a good classy intro which Neelkanth was not prepared for, let's talk markets. Who would have thought that 2018 would be such a nasty year for across the board volatility? From emerging market bonds to emerging market currencies to global developed market stocks, everything has got smoked. What is going on?
See, there is clearly a change of, say, the regime, the prevalent consensus. There was a certain way in which we thought the world was moving from the time that China joined the WTO. The prevailing consensus was that it was about an open trade, a free world, increasing financial interconnectedness, and there's clearly those questions are being raised. So that generally means that there is higher risk aversion. You don't know what can happen in the next 1 year or 2 years or 3 years. That's the first thing. The second is that there was very unconventional and unprecedented monetary policy being followed by the developed world, the G3 and the Bank of England. This was the first year where the balance sheets started to contract. So in the next 12 months, there will be another about $430 billion that they shrink by. And in FY20, that is in the next 2 years, the total could be about $900 billion. So there is a, so the world was used to, for a very long time, and that was part of the design, that you have very low interest rates, you have very easy financing, and that prevented much deeper problems post the North Atlantic financial crisis. But as the growth normalized, as the monetary conditions started to normalize as well, I think there has been quite a bit of adjustment. So there was a phase where every asset class was doing well because there was so much money available. Now we are starting to head towards a more normal environment. So I think on both these issues, the fact that there is a backlash against free trade, there is clearly conflict between the G2, which is not just economic now, and then this issue of tightening monetary conditions after almost a decade of a very easy policy. So there is bound to be disruption, and I don't think it's over yet. I think 2019 we will continue to see some of that.
So Neelkanth, are you saying that it's going to be a little premature if you bask in the glory that we're almost hitting 11K and that crude has seen a decline because of the unknowns that 2019 may throw up, and something as early as the next Fed meet, wherein you still don't know how the world is going to absorb if there is a hawkish tone and a rate hike which perhaps is in the price?
Yeah, so see, the global growth is slowing, right? So I think the fall in oil price from say 83, 84 to maybe 67, 68 was perhaps supply driven. I think people were surprised by the exemptions given to China and India and a lot of other countries, that is the Iran sanctions. And then there was this Kurdish supply that came in, some of the transportation bottlenecks in the Permian Basin in the US came off. But the 68 to 58, I mean, initially, of course, it was just, I think, long positions being unwound because no one expected it to happen. But the last round of decline is actually a bit worrying because, see, if it is supply driven, it's actually win-win for everyone, right? I mean, other than, of course, the oil producers, but it means that demand is good, prices are low, what can go wrong? What the last $8–10 have actually been a bit worrying. Initially, it seemed technical, but what seems now is that growth is actually slowing down globally, and that's not a good sign. So low oil, of course, provides somewhat of a boost to domestic consumption, but it is not a very good sign for the global economy. So what this means is, and which is why you are seeing many of the global indices at 14-month lows, is that you need to have a lot of stress and volatility in the financial markets before the tightening bias. So it's a consensus view, and pretty much what the central banks have guided to has been of monetary tightening, that interest rates will go up in 2019 or expected to go up in 2019. If you have to change that trajectory, there needs to be some amount of financial market stress, which will then trigger the central banks, and it's actually a game of chicken. Your objective is to manage the economy, not the markets. But then the markets, when they throw a fit, then sometimes it starts having an impact on the economy as well, and that the banks have to react to that, which means that there will be a period of volatility, a lot of stress. This euphoria that we are seeing in India, we have to be very clear on what's driving it, right? So the first is that there are significant flows into the Indian equity markets, which is, I think, something that doesn't look like it's changing anytime soon. There are a very large number of small investors which are putting money in. This is classic herd behavior. It doesn't mean it'll stop. And if it keeps happening, so think about it this way. Reasonable years, actually good years in the past, we would see $20 billion coming in from foreign investors. We're getting $20 billion every year now, on a very steady pace from domestic investors. So there is quite a bit of buying pressure. If there's no real panic happening, people then wait for the expected bad news to play out and start buying again. These are, I would call, somewhat technical things. I think the economy in India is actually slowing, and I would be very careful on what I buy. See, the P multiples for the market are driven by much more macro issues, like financial savings being routed to mutual funds, or global monetary policy changing, or the fact that bond yields in the US, which were at 3.2, 3.3 at one point and headed to 3.5, are now back to 2.8. So all of those issues do affect price to earnings multiples, but when it comes to choosing the sectors that we should be in, I think we have to be very careful.
You're unsure about the sustainability of the India rally, right?
I don't expect, I've never expected that the Indian headline markets will correct very badly. I don't think we should expect that even in the next 12 months. I mean, there could be time correction at best, but I have not been in the camp that we should see like a substantial downward adjustment. That may happen. I mean, nothing is impossible. It's the market after all. What may happen is, if there's some accident, another accident happens in say the non-banking finance space, and that triggers a whole lot of questions about interlinkages between, say, banks and NBFCs and real estate and mutual funds, and so all of those questions starting to get raised, and that raises questions on basically basic trust issues. I mean, who can you give money to, and who can you expect money back from? Those are issues which can drive a sharp leg down. Otherwise, I think fundamentally there's no reason why the market should have corrected very badly. I'll repeat that, I think no one buys the Nifty. So getting excited about Nifty doing very well is actually not the smartest thing to do. I think it's much more prudent to focus on which sectors should one be focused on, which stocks should one be focused on.
We've been talking about, Neelkanth, the theme with the consumption and how autos may be peaking. What's your sense there?
I think they have already peaked. Some of the leading edge stocks have actually corrected quite a bit from their peaks, and that's very welcome, I thought. I mean, 5 years back we thought 13, 14 times was the peak for an automaker, because it is after all a very capex heavy cyclical. But there was this phase where at 25, 30 times PE, people thought that, it's a consumer discretionary stock and it can keep doing well. Well, so, I mean, you can't just move from, so when you're selling a car, it's not like selling a washing machine or a mixer grinder. So clearly, some of the correction that has happened is I think very welcome. I don't think we are fully done yet for two reasons. The first is that I think the PE multiple is still too high. And these are classic cyclicals. Globally, automakers trade at, well, I'm not saying we should be going there, but 6 to 8 times. 20 times seems very high. I think 14, 15, given the higher growth expectations in India, may be more fair. The second thing is that, and this is a cycle which I'm surprised hasn't been sort of commented on more often. Maybe it happens once every 10 years, so every time, there are people who discover it for the first time, and then in the next cycle they are not there again. This is the pay commission. I think the pay commission affects the salaries and pensions for almost 3 crore people. The total increase in payout at an annual level is 4.5 lakh crores. There is a much greater propensity to spend it. See, unlike, say, in the private sector, where you don't really expect a lot of sustainability in your bonus. I mean, it's very, very unpredictable to start with, and you don't really expect when you're going to get a big fat bonus. In the PSU space, there are 2 aspects that make it very, very potent for consumption. The first is that it's expected. 1st Jan 2016 is when the new pay commission is due, and your state government or your central government, even if it's late, it'll do it by 2018-19. So the Maharashtra is the last one is doing it from 1st January. So it's coming, so you've prepared for it. Secondly, you can assume this will be there till the rest of your life, and that affects the impact of this in consumption is massive. But the suddenness with which it starts is also is very similar to the suddenness with which it stops. So suddenly it seems that there has been a very sharp slowdown in demand, and you see the 5th pay commission, the 6th pay commission, around that time there was a big spike in demand and then it corrected. So I think both those factors are what keep us cautious on the discretionary stocks, including autos.
If I take a leaf from your earlier comment, your view is that Indian economy is slowing down. But yet in your latest strategy note, you are making a mention that one should buy cyclicals and industrials. Names like L&T, corporate banks, you prefer that. So what is the underlying thought behind that?
No, it's a very important question you asked. Most people intuitively assumed that the economy is slowing and cyclicals won't do well. See, we are slowing to maybe a 6.5 growth, right? So what we are saying is that FY20, I think most people are at 7.5 to 7.8% GDP growth. That may not happen. 6.5 is what will happen. In the last 5 years, we've grown at 7% a year. 7% a year over 5 years is 40%. So if you did not do any capex and you, at the starting point, you were running at 60% utilization, you're now talking about 84% utilization. So you need to do capex, and it's a classic business cycle thing. So even in 2014, before this government is coming to power, we had written explicitly that the business cycle, investment cycle will not pick up despite a change in government. The government did a lot on roads and railways, and yet the aggregate capex even for the government did not change too much. But now what is happening is that you now need steel capacity. And I think in 3-4 years time, it's now the path is becoming clear. It could be 5 years if things don't go well. But you need thermal power capacity. And there is a lot of work happening on the urban side, and this is just democracy in action. So you are starting to see investments in metro rail, from large construction companies. 50% of order books are coming from state governments. So there is one is that 7% growth is a lot. I mean, it may be much lower than what we should aspire for. I mean, I wish we could grow at 10, but the point is 7% is very strong growth. It fills up capacities, and then you need capex. Second is that on the private sector side, there continues to be capex. I mean, even the 2012 to 17 period, where the GFCF, the gross fixed capital formation, which is a measure of economy-wide capex investment, that ratio was continuously dipping. You were actually seeing private sector capex grow at 14%. There is massive capex happening, and you need now new airports. You need the airlines to keep adding capacity. There's a lot of investment still happening in telecom. There are lots of pipelines being set up, and all of these city gas distribution contracts that have been given out by 2021-22. We're talking about 86 new geographical areas where you need to have new gas pipelines in cities. And 70% of India's population can, in the next decade or so, be having piped gas. These are things that require significant amounts of investment. It doesn't matter whether we're going from 7.5 to 6.5. And therefore, on the other hand, the market is positioned very differently. See, the markets, you have to also understand what is it that people are expecting and where will they get surprised. And our view is that people are still too focused on consumption because they think it's safe. They're buying things which are at record high PE premiums. So for both staples and discretionary, the price to earnings premium to the market is the highest it has ever been. On the other hand, in industrials, the premium and the utilities, things are actually the PE multiples, the premiums are towards the low end of their range. And in fact, utilities, they are actually at historic lows. So these are the sectors where we think there is an inflection coming in fundamentals, and the stocks and sectors are cheap. That gives us a lot of safety. Those are the sectors where we would like to be.
Point. Can I ask you one more question, or you need to get on your con call?
I think we can always do with one more question. Okay. Questions are always good.
Thank you very much. Now, the broken end of the market is also the rural economy. And after the state election experience, some would argue that more focus for the rural economy is really coming in. Could that change your calculations and assumptions on how consumption and autos and other discretionary sectors would move in next 12 months?
Absolutely. I think that's a great question. Again, as I had said, the point is there will be rhetoric. There is rhetoric, right? Now, yesterday, one state government made a big announcement, all loans less than 2 lakhs waived. Consumption gets affected when new money goes into the economy. So if you give a fresh loan to a farmer, you're handing over money which then the farmer can use to buy a tractor, for the daughter's wedding, for sending kids to education, or buying a refrigerator, or doing what the money is for, which is planting crops. But if you waive a loan, you're not affecting the farmer's cash flows. And in fact, you're actually hurting the farmer's cash flows because, at least in the near term, because you announced it. Now the farmer stops paying the interest. The bank is not interested in issuing fresh loans. Identifying, because see, how does it work? The government has to pay the bank against an individual account so that the bank can waive the loan. If the bank does not know who this person is and how much should it be waived, it'll take 6 months to 12 months. In fact, more. In fact, in the 2008 loan waiver, it took 2 years and a quarter to finish the loan waiver. In fact, states that have done it, Maharashtra, UP, etc., they've taken a very long time to even identify, and they found that 15% of the borrowers were fake. You need to do that weeding out. While that weeding out is happening, the fresh flow of cash into that economy is actually slowing down. And therefore, I think it's bad for consumption. At least, if you're looking at, what the markets will look at, are we seeing pick up in volumes in the March quarter and June quarter and September quarter? And I don't think that's happening. So this is very different. Now, if there's a GST rate cut, which is also something that is being discussed now in the front pages today, on specific sectors, yes, I think that is a direct benefit, right? So the government is giving a very targeted stimulus, but that's very minor. I think 14,000 crores annually is not something that I would really think catalyzes the market. Will there be other forms of dole? Where is the fiscal space? So, see, we have to understand that desire and ability to do things are totally different things. Rhetoric and action are totally different. So, Raitu Bandhu in Telangana, that's become a war cry for anyone wanting to help the farmer. Raitu Bandhu was 12,000 crores a year for Telangana. It's 1.5% of Telangana's GDP. Where is the fiscal space? Telangana, of course, because of the separation, had the balance sheet to do it. And of course, they worked very hard on increasing the tax collections. So they're not breaching their 3% deficit. If the state governments choose to do a big farm loan waiver, they'll have to find the money somewhere else. Everyone is close to 3% deficit. So it's not going to be additional spending. The year that UP did the pay commission and the farm loan waiver, they did nothing else because there's no money. So I don't think this is really going to help consumption at all. But yeah, of course, the stocks have moved, which I think is a bit irrational, and therefore that gives us an opportunity to trim even more.
Neelkanth, So fantastic to have you back on ET Now, and certainly hope to see much more of you going forward. And next time when we meet, I hope I'm not caught with a surprise.
Okay, good being here. Thank you, Nikunj.
Thank you very much. Okay, now very interesting. You know, it's got a very out of box view. You know, whereas market started celebrating, if you look at state election outcome when it came last week, everyone thought that, look, the focus of the Congress government and the BJP government is that they will have to revive rural growth because that's where the stress is. So market started celebrating that, and all the auto stocks, consumption stocks, FMCG stocks, they went higher. But I think his view is very valid, which is that, boss, you have an intention, but where is the fiscal strength for you to do it? I mean, how will you do it? You are struggling on a disinvestment number. You cannot miss your fiscal deficit. The crude savings have not been passed on because you've not really cut excise duty. So how will you translate intent into an economic reality when you know that you're stuck between rock and a hard surface when it comes to the maths?
Yeah.
That's a great point, actually.
Yeah.